kind of fiduciary practice to not allow people to get out of this situation. These things, yes, they were imperfect because there was no rules allowing for an ETF, but there's no real reason why they shouldn't. And what you're actually doing is hurting retail investors, and it's just not fair. It's not right. Think of the bullshit that gets ETF nowadays. 100x leverage crap. Short stuff. The inverse Kramer ETF.
Yeah.
I mean, this stuff is toxic waste, and yet the Bitcoin one, they don't allow that. I mean, that's stupid. And you've got a lot of retail investors, a lot of RAAs. It was the only avenue you gave them, and you're purposely screwing them over. It's unforgivable. So the dollar, the US is 25% of world GDP, but dollar transactions account for 87% of all transactions on Earth. So the dollar has an outsize versus its actual economic impact. So then when the Federal Reserve tinker around with the supply of money, and they've been reducing it, there's somebody out in the outer world who's like, shit, I can't get my dollars. I call it a game of musical chairs. And the first game of musical chairs was the chair got rug pulled on Sri Lanka. It's the weak borrowers who can't get the dollars. There's less dollars around, and there's so many needs for dollars, so much borrowing goes on that what happens is everybody competitively bids the dollar higher. I need my dollars. And the people who can't fall by the wayside. They can't pay their debts. What I've looked at is global M2. China's M2 is picking up. The UK has started essentially having to increase liquidity to buy UK government bonds. So we're starting to see the potential turn, but the US is still firmly negative. And until the US cycle turns a bit, we're going to see some stabilization in this monetary cycle. But the probabilistic outcome is we have to live in the next 6 to 12 months forward because that's where crypto lives. And crypto bottomed in June. And so what it's saying is the rate of change of liquidity is now somewhat improving. It's still negative. So I think crypto gave us the signal that things are changing at the margin, but it's too soon for it to fully drive prices. So I think I was just with an interview with Mark Yusko. He put it really nicely. He goes, crypto winter finished in June 14th. We were already seeing the rise of AI, and AI is terrifying in deep fakes. It's terrifying in what it can do and who it can be online. How do we know who's real and who's not? Well, identity is a urgent solve. It's an urgent solve because we're getting abused by the larger platforms because they use our identity, package it up, and sell it to advertisers. Why should that be the case? Why should we not participate in that economy? That's coming. I know all of the big Web2 platforms. I know them well. They all understand this. They know where it's going. It's just a matter of how do they transition away from advertising as is. But sharing it with the community, I think, is an important and powerful role. So in a digital world, everything digitized goes to zero in value because you can make infinite amounts of everything, including content, something we talk about at Real Vision a lot. Anything that gets digitized. I think proof, I'm thinking that the RV NFT is less about the art, even though the art is gorgeous and the community was involved in building that out. It's actually a Genesis NFT of the entire Web3 build out of Real Vision, of which there is a tremendous amount going on. And I've talked about the tokenization of Real Vision. It is a membership to a club, and it's a membership to a part of that massive Web3 future. So that's how I think of it. It's kind of like a Bored Ape was your passport that accrued value over time for all of the things that Yuga Labs did. But it has the utility that Proof has, where it's actually a club where you get to meet other interesting people and create opportunities together with them. So, the good thing about Real Vision is, we're not just doing an NFT for the sake of an NFT. It's actually a core part of how we believe in community and utility that we can drive. We're looking at things like no secret crowdsourced asset management. And for me, I'm very interested in the broader layer. I'm very interested in ticketing and where this is going. I think in Argentina, somebody's been doing it for for airlines, which is something I've been talking about, and 6529 myself talked about this for a while. I'm really interested in films and film franchises, film financing. I was part of a documentary that you guys have seen. They've got some NFTs called New Here, which is amazing. Ben Mesrich has been on many times, and we'll follow that story as it comes through about what he's doing with books, film scripts. Um, I still am very interested in seeing how culture coalesces. I've always got my rec guy is up, and whether it's the rec guy or Max Payne and friends, they're all about the culture of crypto, and we're all in this together. I find that very interesting. It could, but we're all taught one thing. It's a Pavlovian response, and we know what it is: more cowbell. And I wrote about this in GMI this weekend. It's basically the answer to everything is more cowbell, i.e., print more money. So as the bond market starts to become even more illiquid, it's bloody illiquid now. I think it's broken. It's broken away from the business cycle. It's broken away from inflation break evens. It's completely not tracking anything. It's like on its own, unanchored, untethered. Um, that's going to produce unintended consequences. Does the equity market need to break? Not necessarily. The bond market has broken. This is the worst performance in bond market history. This is the worst performance of 60/40 portfolios in history. What we're actually doing is breaking the baby boomers' pensions. And politicians don't like that stuff because guess what? They're all baby boomers and all their friends are baby boomers, and baby boomers are 76 million voters. The last thing they want is to upset those people. It means where there's not enough participants in the bond market because they're hampered by regulation or market conditions to allow for the smooth setting of prices by the market itself.
Right.
And a function of that can be bid offer spreads widening. So anybody who's in crypto will know a very illiquid token has a wide bid offer spread. And that becomes very costly because you buy it and sell it because you've changed your mind. You've lost a decent amount of money. The bond market is the biggest, deepest, most liquid market on earth, and it's become illiquid. That's a terrifying thing. Why is that? It's because bank regulation has meant that banks can't buy or add more treasuries to their balance sheet. They have parked all their capital in the reverse repo system, which is another fancy place that you can park money with the Federal Reserve, which is shut out of the market. So the banks can't get involved. And the US is like, we need it to fall ahead of the election. We need to get inflation down. And the Saudis is like, well, we don't really want oil at $60. We want it over $100. So they cut supply. So the break-even rates of inflation, which is the market's future inflation gauge, just rocketed higher in the last 2 days. Well, that's a problem because it means the Fed need to go further. And if the Fed need to go further and the bond markets are liquid, the bond market's going to overshoot further, and then the dollar overshoots and it blows up other economies. This is a bloody mess. And I think it's broken.